1031 Exchanges. A guide to deferring real estate taxes. Real estate investors have a powerful tool at their disposal to postpone capital gains taxes: the 1031 exchange. This IRS-approved strategy allows you to sell an investment property and reinvest the proceeds into a like-kind property, deferring taxes indefinitely, as long as you adhere to strict IRS rules. The goal isn't to avoid taxes forever, but to strategically reinvest capital for greater growth. How 1031 exchanges work. A 1031 exchange essentially rolls capital gains into a new property, instead of triggering an immediate tax bill. This is particularly valuable because capital gains tax rates can reach 20% federally, plus additional state taxes. By deferring, investors retain more capital to expand their portfolios. To qualify, the sale must involve investment or business use real estate, with proceeds reinvested into another U.S.-based investment property. Strict deadlines and the use of a qualified intermediary are essential. Key rules and timelines. The IRS enforces two critical deadlines: 45-day identification period. You must identify potential replacement properties within 45 days of selling the original property. The IRS offers two options: the 3-property rule, naming up to 3 properties, or the 200% rule, identifying any number of properties as long as their combined value doesn't exceed 200% of the sold property's value. 180-day exchange period. The exchange must be completed within 180 days of the sale. Missing either deadline invalidates the exchange, resulting in immediate tax liability. Types of 1031 exchanges. Several structures exist, but the most common involve simultaneous or delayed exchanges facilitated by a qualified intermediary. These intermediaries hold the funds during the exchange period, ensuring compliance with IRS regulations. Why investors use 1031 exchanges? The benefits are clear. Tax deferral, postponing capital gains and depreciation recapture taxes. Portfolio growth, reinvesting full proceeds for larger or better performing assets. Consolidation diversification, streamlining holdings or spreading risk. Estate planning, potential step up in basis for heirs, which may eliminate deferred taxes. Common mistakes to avoid: failing to meet deadlines, receiving cash, known as boot, attempting a DIY exchange, or using the property personally during the exchange period can all invalidate the transaction. Alternatives to 1031 exchanges. If a 1031 exchange isn't suitable, consider options like opportunity zone investments, installment sales, spreading tax liability over time, REITs, or the primary residence exclusion for personal homes. Real-world example: imagine selling a rental property for $800,000 with $250,000 in capital gains. Instead of paying a potential $50,000 plus in taxes, a 1031 exchange allows you to roll the proceeds into another rental property, deferring the tax bill and keeping more capital working for you. Conclusion: a 1031 exchange is a powerful tax strategy for real estate investors, but it requires strict adherence to IRS rules. By understanding the timelines, identification requirements, and potential pitfalls, investors can maximize their wealth while deferring tax obligations. Mastering these regulations is crucial for long-term portfolio growth and financial efficiency.